everyone. Good to see you all again. Welcome to the very first Tuesday afternoon networking of the new year. As most of you know, my name is Coco T.A.N. I'm a full-service real estate expert with Keller Realty in the San Francisco Bay Area. 2022 looks to be a record-breaking year for the home sales in the Bay Area. If you haven't recently searched up for what your home is worth, be prepared to be shocked. It may actually be time to call a realtor. So this year is moving up very quickly by. So be sure to stay up to date with what's happening in the real estate world by adding me on WeChat and WhatsApp and subscribing to me on YouTube. I have all the QR codes behind me that you can scan straight off your computer screen. This month, I sent out my new red and blue colored postcard, this one, and on the back, it says, grow your knowledge, grow your wealth, which why I hold the T.A.N seminars for all of you. Today, we're gathered to receive a New Year's tax updates before the 2021 taxes are due. Laws change every year, both local and state, and it's hard to stay on top of everything. What are the new brackets for income and for capital gains? There's still time for PPP loan forgiveness and ERC qualification. And what does it mean for us that Biden's tax proposal did not pass? To talk about all that, we're once again bringing back our CPA Zhai to be our guide. All right, so Mr. Zhai is a CPA, CFP, MBA, and partner. A 25-year practitioner helping dozens of small businesses from startup to growth. Mr. Zhai specializes in tax planning and preparation for individuals, trusts, and corporations, as well as small business accounting, payroll, and benefits. Whatever the current law is, he's on top of it. He's also here to answer your questions. So if you have any, you can type them into the chat to a co-host, and they will be gathered and answered after the initial presentation. So, Mr. Zhai, the floor is yours right now.
All right. This is the slide that we're going to talk about. My name is Zhai. Last year, I came here for the Biden's tax proposal change. Thankfully, that law didn't change, so the tax rate is still the same. We still enjoy Trump's lower tax rate. So let me start with put a lot of number over here. We're still going to see 7 tax bracket over here. There's no 39.6 tax rate yet. We're still paying for 2021. If you make a little bit over $500,000 as a single or 628,000 as a couple, you're going to see the 37% rate. Otherwise, the tax rate only start from 10% to 12%. The longest tax bracket is from the 24% over here, in the middle over here, 86,000 to 160, and for the couple is 170 to 320. That's cover a lot of ground for the people who is an engineer, has a professional job, pay more than 6 digits figures. You still pay 24% on the federal, okay? So in today's seminar, we mainly talk about the federal situation. The state, we will use one slide to touch about California state. But let's go on with the federal tax return. So today is actually February 15th. So by today, all the form 1099 series, 1098 W2, 1095, all kinds of 1099 Series B for the stock. If they want to make change, they should send it out, and you're supposed to receive in your mailbox. You need to gather those information, sort them, and make sure they belong to you before file the tax return. Sometimes it's probably belong to your kids. If you use your kids' name to do the investment, don't put those investment on your tax return. We did see those before. That's very unfortunate. The kids doesn't have to pay your tax rate or your W-2 rate, okay? So don't do that. And also, if you receive the stimulus check for the third time in Biden administration, you should receive a notice called 1444 to tell you if you got $1,400 or not. If you didn't get the $1,400 in the third stimulus check, you can claim that credit on 1040 line 30 if your income qualifies. Normally, individuals should earn the 75,000, couple in the 150,000, you are still qualified to get the $1,400 on your tax return. And also, there's another letter 6419 for the child tax credit. IRS decided to, for the qualified people, give them around $330 every month, so they can go by to pay the family bill if they need. So there's a letter come out to tell you IRS advance how much tax credit to you during the 2021. Make sure to deduct from the credit you claimed on the tax return. Otherwise, you will receive IRS letter says you are double claimed. And also, just remember, a lot of people still on the unemployment benefit. California unemployment benefit is only taxed at the federal level, not on the state level. And on the federal level, they also have around $10,000 exemption for the people really at the low income rate. The first $10,000 may not be taxable. Please do check on the Schedule 1 when you claim that you are tax rate. And also the PPP loan forgiven, you don't have to pay back. That is the federal is decided they are not taxable, so they are tax exempt. You don't have to really report it, but the state have a little bit of formula. If your income doesn't go down like 25% or 20%, I don't remember what's the percentage, but if your income doesn't go down, the forgiven of the PPP is still taxable. Make sure you talk to your accountant or your tax accountant. Make sure if you need the including for the state. And since we talk about the PPP, I just want to let every small business owner knows your first PPP and the second PPP is available for the forgiveness. For forgiven process, it's pretty simple. You just need to gather all the information. If you haven't get done this being processed, make sure you get the email from the place you get it in the bank or online. They have a process to lead you to get the loan to be forgiven. You don't want to carry the loan in the end if you still have to pay. You need to demonstrate that you spend the money to the qualified expense within 8 or 24 weeks period after you get the loan. And so you don't owe federal government any money when we come out from the pandemic, okay? And also there's another very generous credit, which is called the employee retention credit, available for the small business. This credit is $5,000 for 2021 and the $7,000 for every quarter for the first 3 quarters in 2021. Oh, okay, $5,000 for 2020, $7,000 for every quarter in 2021. So if you didn't fire your employee or let them go home, you still keep them on your payroll, you should get like either $5,000 or $7,000 from the federal government. And make sure talk to your accountant or whoever do your payroll. You make sure to claim that benefit, because we do see the money help business owner a lot. All you need to do is have them file the payroll return to claim them back. Okay, so ERC is still ongoing. You can still file the amendment to get the money back if you didn't know that. Okay. And the next slide is we can review our seminar is to show where is the place you can claim to get more tax deduction or tax credit. But what is really the deduction and what is the credit? A lot of people is a little bit confused about it. I'm gonna use accounting term when the people review their financial statement or on the tax return. It's called above the line and below the line. If the line is how much taxable income or the tax you need to pay, above the line means that is the tax deduction. So any money you claim above the line is to offset your taxable income. So at the line you calculate how much tax you will get to pay. And the tax credit is the below the line deduction. There normally is dollar to dollar offset against the tax amount. So we may ask a question, do you prefer tax deduction or tax credit? So normally dollar to dollar is you use more benefit for ordinary people because they are dollar to dollar against the tax. So in this year, I bring in the biggest tax deduction normally is the standard deduction. The standard deduction right now is so big, a lot of people, if they don't have a higher loan or the loan rate are too low, they can't itemize anymore, okay? So in 2021, if you don't make $25,000 100, you probably don't have to file the tax return from W-2 income because the first $25,000 can be fully exempted by the standard deduction for a couple. And it goes down for the head householder at 18,800, single is 12,550. So you have kids is become go to school, they make some money, no more than $12,000. You don't need to pay the tax, okay? But we may still recommend them to file the tax return to claim some tax credit, like AOC credit or stimulus check credit. You won't get those credit if you don't file the tax return, okay? Over here, I'm going to talk about the one tax credit being changed a lot, which is called the child tax credit. The amount was newly enacted for the 2021. So if you have kids under 5 years old, 5 year and younger, if you qualify the income we list over here, married is 150,000. all the way to the single is $75,000, you can get $3,600 tax credit, means dollar to dollar offset to the tax you otherwise need to pay. 6 to 17 is $3,000. That number used to be only $2,000, so it still qualifies. If you have adult kids over 18, under 18 years old, there you can get still at $500, as long as your income is not over 400K. Okay, single is 200K, and kids as a full-time student go to college at the 19 and 24, they can claim $500 still. After 24, they probably can still claim the $500 tax credit if they live with the parents and they're supported by the parents and they don't make money over $4,500. So if you have a kid, yes, between the job in the home for the whole year, you probably still can claim $500, even they are over 24, since they don't make any money, no more than $4,500. Okay. So the next slide change is also very big. It's called the child tax credit. Used to be only $3,000 for each kid, 2 kids $6,000. In 2021, this number not only doubled, it increased almost twice. Single kids, you can claim $8,000 for one kid, and the $16,000 for the 2 qualified kids. Normally, qualified kids means they're under 13 years old. You send them to the after school or child care, so you can go to work. If you do send those, don't forget to gather all the after school expense and file the correct form. You can earn about 8,000 multiplied by the property rate. Okay, if your income is lower, that applicable rate is higher, like 50%. If your income over 34,000, I think the rate is gonna go down to at least 20%. So 20% on the $8,000 qualified expense, you can still get $1,600. Although if your income is lower enough, this could be as high as $4,000 because the applicable rate is 50% on the $8,000. So so 2 tax credit. One is a child tax credit. It's taken by taking how many kids do you have on each head. Okay. Another one is child care tax credit, means the after school care. Okay. So you have to send the kids to a care facility to get that credit. Okay. They both increase for 2021. And the next we move to a slide is long-term capital gain. In the Bay Area, I met a lot of our client or a lot of people when I do the seminar. They either do quite a volume of a trade or a flipping on the house. Both of them, if they generate the money, you could facing the long-term capital gain. And I try to over here to make sure you understand how long-term capital gain is being taxed. Okay, in the long-term capital gain, just like income tax, they have a 3 level of a tax rate. In the income level, we saw like 7 tax rate. In the long-term capital gain, they have 0%, 15%, and 20%. And actually, there's another very odd tax rate called the 3.8 net investment income tax, so-called the Obamacare tax. It was passed as a law after Obamacare was passed in 2013. So for right now, I just show you the 3 tax bracket over here, and it also depends on your income level. If your income level is lower enough, like for the single under 40,000, married couple at 41,000, you don't need to pay long-term capital gain. So that's a good planning opportunity for the people is just retired. If you don't have a W-2 at the bottom and you only have a long-term capital gain, and you can sell some long-term capital gain and pay $0. Okay, and that's actually is a very effective tax strategy for the retired folks to sell certain portfolio to step up their gain, and they can sell the stock to report the gain at the 0 tax rate and immediately buy back the stock. So every year you could use that strategy to skip the capital gain tax if you are at the 0 tax bracket, which is $40,000 and $81,000 for the couple, and it will go up at the $15,000 if your income between this level here. So you can see the 15% tax bracket actually is very long, from $40,000 up to almost $500,000 for the single, and for the couple $81,000 to $628,000. So majority of people will pay 15% if your W-2 income at the bottom. So and at the bottom and stock up all the capital gain on the top. If you're still under this bracket over here, you just pay 15%. it will break out your income level to $500,000 or 628 for the couple. Your tax rate could see at 20% over here. A lot of people confused about another tax, which is called the Obamacare tax. So in the next slide, I'm going to use a case study as a couple to show you if a married couple, how do they pay the long-term capital gain? In this slide, I'm going to introduce another tax rate called the 3.8. So I have a couple progressive rate start from here. The zero tax bracket at the zero, and they won't be taxed up to you hit the 15%. At the second circle, blue circle over here, 81,000, which means if your income, total income at the $0 to 81,000 for a couple, any capital gain like resides in this tax bracket, you pay zero. Okay, and now it's gonna move up. If you to the next level at the $250,000, 250, your capital gain is, you're gonna see another surcharge tax rate called net investment income. So if your income from 81,000 goes up to $250,000, 250, you not only pay 15%, you also pay 3.8% for the net investment income, and it is still gonna grow. If your income goes up to 628 as a couple, your bracket is gonna hit to 20% plus 3.8. So technically, if you have a company stock or the stock you are trading, or even the house you've been holding for more than a year you want to sell, you could be looking at to pay almost 24% on the federal rate. Okay, so that is why now this, as I said, this is only the federal rate. The state rate is normally 9.3 or 10.3 or 11.3, depends on the state income you will have. So typically for the people who have a long-term capital gain, basically they always ask me how much tax I'm gonna pay. I first need to find out how much income do they have. So with the income under 628, you probably most likely pay 18.8% plus California 9.3. So it's about 28 or 29% over here, and over everything in. Okay, so 28 or 29 for the income level over 620K, you'll probably pay as around 35 or 36%. Okay, so that's the long-term capital gain, and still they are still lower than your W-2 income tax rate, and I don't know how long we're gonna see this kind of long-term capital gain. The last year we did a seminar, Biden tried to make them pay the ordinary rate, every kind of a proposal we already seen, but still we still gonna see the long-term capital gain, what we see over here. Okay, now we move on another topic, talk about what kind of deduction can you claim on your tax return. Here I listed some probably good for either a W-2 income owner but more and more deduction actually only can be taken by the self-employed owner. The first two is the medical expense deduction. We saw a lot of retiree folks can claim this because their AGI gonna be low, because they don't have a significant W-2, but they have a lot of medical spending. So if you spend over 7.5 over your adjusted income, you probably get some deduction. And the cash donation is always good the good way to quickly claim the tax exemption, the income exemption to knock off from your top rate. So 60% of income can be donated as a cash. If it's non-cash donation, IRS allow you to count 30%. Okay. And if you're taking care of your family member who is the state government pay you in-home service support, like home care support, those W-2 normally are tax exempt. So don't report that as your normal W-2. You probably can do some exemption on your tax return. And from this point on, it's basically the business owner or the people who have a side gig earns self-employed income can claim. If you drive Uber drive, every mileage you drive or you see your client is 56 cents per mile, you need to do the mileage log. So you can claim on the tax return for the standard deduction on your per mile. And a lot of people still working from home. If you use your business for your self-employed income, you can claim on the Form 8829 form, which is a home use deduction. You can report your property tax, which is otherwise limited at $10,000, or your mortgage on certain percentage you use for your home, including your utility cleaning fee or those. So you can take some deduction against your self-employed income. Again, I gotta stress it here, only self-employed people can do this. The people who on the W-2 may not be able to claim the home office, even you majority time still spending home, okay? Because the home usage as a business deduction, the whole section is abolished by the Trump tax change in 2017. It's gone. You cannot claim anymore. And the business owner normally can use the section 168 and the 179, which is mainly the bonus depreciation or salary depreciation to buy fixed assets and claim a lot of income not to be taxed. And also, if you buy a car, if you claim depreciation, normal car only can depreciate no more than $10,000 or $16,000 on the second year, and the third year is dropped down to no more than $9,700. So it really depends on what kind of car you buy. If they are not a heavyweight car, here is the limitation for the deduction. Okay, and the one good news is for the people who doing business, if they have a meal, no matter is dining, wining the client to do the business development, if the meal is provided by the restaurant, you can claim 100% for 2 years now, 2021 and 2022. So if you're a business owner, need to provide the meal to close your deal, to dining with your client, you can claim everything on the meal. In the before, I normally joke about you only can claim 50% because another 50% is eaten by the owner themselves. The owner needs to eat the meal anyway, so IRS doesn't allow you to deduct it. I don't know if it's true, but after this year, I think it's going to go back to 50% again. Only the half meal are tax deductible. There's another very good tax deduction called the 1099 Cap A deduction for the self-business owner. And I probably going to have another slide afterwards to talk about basically 20% the business pass-through income to an individual tax return. You can exempt 20% of it, and also due to the pandemic and the CARE Act passed in 2020, the Congress allow you to report the net operating loss if you suffered in 2020 or 2021. to go back, carry back to all the way to 5 year back carry over. So when pandemic was broke out at 2020, if you suffered the loss and you still suffer the loss in 2021, you can get the money back as far as around 2016 to get the taxable income you paid at that time back. Okay, so that's kind of the NOL, net operating loss carryback. Okay, that's one way to save tax for business owner too. And we can, I said everything I talk about here is a federal, but I reserve one slide over here to talk about the California conformity. Now, California conform a lot of things what the federal said, but a lot of things they don't confirm. I list over here. Limited as a $10,000, but California actually still allow you to take full property tax deduction and the DMV against your state. So when you file the tax return, don't just report the $10,000 and stop on the federal return. Report everything. Maybe your tax software will use the full amount to deduct the state return. Okay, and also kind of that's actually a good thing of not conform with California. But the bad thing is second one, they don't conform with casualty and the theft loss. Means if you suffer the loss, you can deduct 10% or $100 more on the loss, you know. And the federal right now doesn't allow that too, but they do allow if you have a federal declare the disaster like the forest fire kind of thing, you know. And the HSA is only good for the federal, and the state government actually doesn't allow you to deduct any HSA. Okay, just to let you know so. And there's no deduction for the education credit, which is a 2005, and the lifetime learning credit, $2,000. California doesn't have such credit. California also tax on the early withdrawal for the K-12 student from 529 distribution, and they also charge 2.8% penalty if you withdraw 529 saving, not paying the college, but paying for the high school or private school kind of things. So try not to early withdraw from your 521. Those money is actually saved for your college. Okay, California doesn't allow you to get a tax-free withdrawal. There's also no conformity on the alimony. The federal after 2018 doesn't have to report the alimony you gave to your ex-spouse, but California still allows it. You know, you can deduct the money you gave to the ex-spouse from your tax return. You don't have to report it as an income because you already spent the money out, you know. And also for Section 179 spending, basically it's a salary depreciation. You can depreciate a lot of money on the federal, but the California only allows $25,000. And also we don't confirm RIA contribution because normally after 70 years old you cannot do RIA contribution. Okay. And also there's one interesting, I realize a lot of people actually doesn't know, California doesn't have a capital gain. If you have a capital gain, the tax are the same as your ordinary tax. So it doesn't matter you sell short term and the long term. The capital gain rate is the same as your income tax rate. So there's no point to claim to differentiate the long term and the short term in the California. They just want to take your highest rate, depends on what kind of income you have. Okay, and there's a no net operating loss carryover on the federal on the California. You only can carry forward to the future, but not to the back. Okay, so those are the different rules make the tax filing difficult. I don't know how many people, when they file the return, majority of people rely on the TurboTax or computerized preparation program over here. If you have anything over here you feel you didn't do the right, you let us know. We can help you to review if you can get the money back. Normally, any 3 years you did it wrong, you still have a chance to file amend the return to get the money back. Okay. And I know there's a lot of people at the Coco's community over here is a self-employed owner. They don't have a corporate support. They work for themselves, and that's why we want to spend some slides to talk about small business benefit. During the years I consulted with my client, I think two biggest things the small business owner can use nowadays is Section 168 deduction, which is bonus depreciation, and the one is 199A Cap A deduction over here. This is a normally can supercharge your tax deduction to the highest limit, like 168 allowed to write off everything you buy, no matter new or used property, normally 5 to 7 years depreciation schedule, up $1 million. That's a lot of money. It can be exempt from your otherwise taxable income. And after Trump's tax reform, starting from 2018, if you have a small business like LLC or S corporation, they are all treated as a pass-through entity. Any income you left from there, 20% of them are tax exempt. This rule is try to line up with the C corporation. The tax rate decreased from 35% to 21%. So the 20% exemption fit to a lot of the business. So as long as the business have a qualified business income, qualified means you have a U.S. sourced business. Your business has to be domestic operated, cannot be overseas operated. No investment, only income. Okay, not like certain kind of dividend or a stock only kind of investment. You have to. The goal is try to provide the jobs. You have employee perform as an ordinary business, and you also spend more than 250 hours every year on that business. This is one of a qualified condition too, and but it also excludes certain profession if their income is too high. Normally as high as a 320K or 420K. So normally at that 33% tax bracket, as a physician, lawyer, we as a CPA or consultant, if your income is too high, you cannot claim the 20%. But for a lot of engineer, architect, sales, realtor, you guys are still qualified. Even you make a lot of money. The 20% can be exempt. As long as they are self-employed, earned in the United States, you spend 250 hours. And the calculation is pretty complicated. There's a special form now called the 8995. Make sure if you want to claim, you have to submit that form, okay, to do the calculation, okay. Our firm handle a lot of foreign tax issue. That is one niche market that we are practice on. I'm still gonna go through a couple of topics because this reflect one aspect of immigrant workers in the Bay Area here. Okay, and a lot of people is also owns the business from overseas. So I just gonna talk about the high level issue over here, how to comply and how to report it. Okay, basically when you talk about the foreign tax, you have to remember IRS and the Congress looking at the two aspects. They not only want to know how much income you make from overseas, they also want to know how much assets do you have, including the foreign bank, foreign financial assets, and the company what you own. And they make very clear about it, you have to report. If you don't report, the penalty is very heavy. It's not only the normal penalty, it's also the criminal indictment. Okay, so a lot of things in the laws over here, they have a massive penalty, and from $10,000 to $50,000. Some even worse is you probably can go to jail for that. Okay, so I cannot not talk about too much technical. Basically, I want you to remember, if you own 10% of a foreign company, don't prepare the tax return on your own. Try to talk to your tax advisor. If you don't know, you're not gonna able to finish very complicated form like 5471 or the new form for the guilty tax on the 8992 there. I gonna have a chart to list all the form over there. I don't think normal people should go through the tax questionnaire provided by the TurboTax to accomplish the tax compliance, because it's just too complicated. You know, it's not like Schedule A, Schedule B. You can report it. You know, it involves a lot of tax planning and analysis to finish it. So if you have foreign issues, do talk to a professional. You don't know where you could be doing wrong, you know. And there's one topic for the people either in here or just coming here. Their family is here, but they have a job from overseas. If they stay overseas, the first $108,000 could be tax exempt. Can be income excluded. So it means the first $108,000 you don't have to pay tax on the United States. But I just want to remind you over here, that doesn't mean the IRS gonna give you the money back. You know, it's just that they don't want to pay the double tax, because this $108,000 probably paid the tax at the overseas already. You just don't need to pay double in the United States. And if you do, but they need to have some days to qualify. The 330 days qualify you as a physical presence or bona fide residency test. Both of them require you have an uninterrupted stay overseas. And even you are not qualified for 180,000 income exclusion, you still can qualify the things called the foreign tax credit. So this used concept is you either excluded $108,000 above the line as an income, or you can get the tax credit for the tax you already paid from the overseas below the line. Okay, so if you already pay the same income tax at the overseas, you can use those overseas tax to offset the tax you calculated in the United States. So there's another example to use above the line and the below the line analysis to see which one is benefit for you. Okay, and and also, as I said in the beginning, this RS also require you, if you stay overseas, most likely you either deposit the money or invest money overseas too. Okay, and a lot of immigrants still not cutting the tie to their home country. if you have some money saved as an overseas bank, you need to report it. Otherwise, penalties are very heavy. Okay, and IRS basically want to know almost everything. Okay, anything you own. I have a chart over here. On the first line over here, any bank over $10,000, you need to report on the form 114. If you have a 50,000 single living overseas or $100,000 couple living in the United States, and you have a foreign investment account, you need to report it, 8938 form. And the bottom three is related to the company. Depends on you have an offshore company and the onshore company, or you own 10% of a company. Every different scenario have a different form to file. Corporate 5, 5471, partnership 5, 8665, offshore company 8621. The sheer member of so many forms, I don't think anybody should handle themselves. Okay, and if you have a complicated investment scheme overseas, do talk to your professional. Okay, they can help you to do the tax compliance. Okay, so all those forms is coming from the law called the FBAR law, FEDCAR law, PFIC, CFC, guilty. Okay, it's alphabetical soup over there. Okay, and the last, this pretty much concludes our presentation. Before I open the Q&A, I just want to introduce some service our firm do, and also the fee we charge. We are still very reasonable charge the CPA firm in the Bay Area over here. Despite the cost increase, we just charge $400 per return for the federal and the state, and it depends on your special situation. If you have a self-employment, that's another $150 for the rental. Each rental is $75. This can help you to save a lot of time and concentrate on your life, not try to do the tax over there. And all kinds of foreign tax compliance. And we also, with that kind of fee we paid, we also provide one complimentary consultation every year. This can be broken into the 30-minute appointment or 15 minutes telephone call. Those can add a tremendous value to our client, so they don't have to go on the Google website to look different post, but you still didn't know who says right. Okay, that's what professional service for. Okay, the last I'm gonna leave our the WeChat group. We also have a chat group can help our existing client and the future client to post some tax discussion over there. You can scan the code and leave your question over there, or find us or our staff. We probably can help you if you don't have just one way, not only the call. You can talk to us too. Okay, Coco, I think I finished my presentation over here. You can leave your chat open.
Great, thank you. Thank you, Bing. Maybe you can unshare for a second so that we can start our Q&A. There's still time to submit your questions for our CPA. So if you want, you can please submit your question to the co-host. Yeah. Bing, you want to unshare for a second?
Yeah, sure. Let me stop.
So the first question I have is whether capital gain is counted into income when determining which category it should be. I guess it's when you determine which category it should be, whether the capital gain is actually counted into regular ordinary income.
Well, capital gain consists of I think what she asked is capital gain the same as ordinary income? No. Okay, capital gain is their own category. They are different. They derive from the investment in the stock or real estate or other private company type of investment. Okay, and they're coming from different background and they are taxed differently at only 3% tax bracket, 0, 15, and 20%. So I don't know if that's the question he asked.
No, they give you example. So he said, in order for you to understand his question, let me say an example. So someone earns $0 but has $1 million long-term capital gain.
Okay.
In this case, whether he or she belongs to the 0% bracket or 20% bracket.
Is this single or couple? If single, well, if you go back to our tax bracket, so if he have a 1 million capital gain and they have a 0 salary, that means the first $40,000 as a single are tax free, 0%. Then from 40,000 all the way to almost $500,000 at the 15%, and anything over $500,000, 28K, it will be at the 20%.
Okay, and then the same person has a question for a single-owned LLC owner. Is it 1065 required to file?
No, single member LLC to IRS are disregarded entity, means they are not tax entity. They don't have to file the partnership return. They can just file a Schedule C on the individual return.
Okay.
But one thing that I want to add, but California still want you to file the LLC return. Okay, so it's very odd. The federal doesn't have to file, but the state has to file the LLC return. Okay.
Okay.
All right.
Okay. The next question is, hi Bing, I have a question about deduction of loss on sale of a property. For rental property, we can claim deduction, but for owner-occupied property, do we need to first convert the property into rental? And if this is the only way, how long should the property be rental property before selling it? Oh my gosh, I haven't seen any property has been actually having loss now, huh? But
yeah. Well, let's just do hypothetical analysis. You know, if your owner occupied the property, the tax rule is if you have gain, you have to pay tax after the qualified exemption at $250,000 per person, right? But if you have a loss, which as a Coco, as a very experienced realtor, I don't think you ever see this in Bay Area, but I do see this in the different parts of the country. You know, they own the property for 10 years, they can still lose about $100,000 when they sell. So the IRS says if you don't do if you owner occupied the property or vacation home sell at the loss are not tax deductible. Okay, so you cannot claim the loss, but you need to pay the tax when you have a gain. So if you want to report the loss, in her question ask, how can you convert to a rental? You need to rent 2 years before sale, and then you can report the 2 rental on your tax return. Then that property can be converted as a rental, and when you sell rental at the loss, then you can claim the rental loss against other gain. Okay, and even against your W-2 gain. You know.
Okay. The next question is, one rental house counts as qualifying business income. The rental income, I guess.
Rental income, yes. They are qualified as a QBA, as a 20% that can be tax exempt. but you need to be able to demonstrate that you spend enough time on the property, and every property should do the record keeping separately. There is a safe harbor rule. I'm not gonna talk about it here, but just remember, it basically you need to keep track the gain and the investment separate, and spend 250 hours on the rental. Okay.
Okay. And the next question is there a proposal to change 2022 LTCG treatment for low W-2 income in any of the Biden's BBB tax proposals?
I'm not gonna guess when the Biden's tax proposal gonna be passed. I think he probably gonna too busy with the midterm election or whatever. Normally, I think with all the interest rate are gonna go up, the inflation and the midterm, only my opinion, I don't think it's gonna be passed very quick. The political decision should be made before 1 year before, not in the same year now in the midterm election, or at the time the Fed are gonna increase so much rate. It could be suicide for the Biden. So that's my opinion.
Okay. The following question: to file tax return claims IRS refund, the statute of limitation 3 years from the original due date, April 15th, or its extension due date, October 15th.
Yeah.
And also the statute of limitations also 2 years from the tax paid. If the refund was from prior year tax return that was filed less than 2 years ago, can it still be claimed as refund?
Okay, I probably lost it at halfway. I understand that he tried to do
the refund.
Basically the amended return can be filed any 3 years before you made the change on the return. Okay, if your return is being filed either on April 15th or October 15th, you can add 3 years as a statute of limitation. If you run off the statute of limitation 3 years more, you probably cannot change anymore. I don't know if he have a second scenario says you pay the tax or what, it's gonna become 2 years. I have to check. I don't know. Normally it's 3 years after the previous filing. Okay. So you can file amended return on amended return. Okay. So you can do a second amended return though. Yeah.
Okay. The next question: we sold our primary home February 2019 and used the tax credit and sold our primary home again October 2021. We should be qualified for the $500,000 tax credit, correct? Twice, right?
I think they may or may not be. Are they past the two year wait? If you sell it in the 19, you should wait two years to 2022.
2 years to 2021.
Oh, 2 year 2021.
So it should be okay, right?
I think it should be okay if you're more than 700, 72 days. You have to wait 2 years to do another time. But normally my calculation is in the 19th, you already claim once, you need to pass 2 years. So wait to 2022 to sell it,
2019 plus 2 is 2021. So they waited for 2 years.
Not if they sell in January 1919, right?
February 2019, and then again October 2021.
October, so it's more than 2 years. Yeah, I think it should be fine. Yeah.
Okay. The next question is related to 1031 exchange. We're actually going to have another seminar for 1031 exchange, but I think we can touch on it very quickly. So, Bean, can you speak a little bit about what to be aware when filing taxes as it relates to 1031 exchange? A special thing to keep in mind is he recently completed the 1031 exchange. The relinquished property was sold in 2021, but the replacement property was closed in 2022.
Okay. So when you sell 1031 exchange, you should be very aware about the 45 days time window and the 183 days. Okay, that basically says after you sell the previous property, you need to identify the new property within 45 days. You probably can identify many of them, maybe 2 or 3 of them. But if you want to make 1031 to be successful, you need to close the new property within 183 days after you sell the previous.
I think that's the general thing about 1031, which we can address in another seminar. But I think the question is more about the relinquished property was sold in 2021, but then the replacement property was closed in 2022. Is there anything that they need to pay special attention, or is it just a regular? So
can you repeat again? They bought a new home first
in 2022.
Yeah.
So it's within the time frame, but the property was sold in 2021, and then within the time frame, but the replacement property was closed in 2022. Yeah.
Okay. Oh, okay. I understand. They want to know how to report
whether anything special since the 2 different years. Yeah.
Yeah, 2 different years is my suggestion is to file the extension to cover the reporting period, because the earliest you can the latest you can close the 1031 is before June 1st, right? So by the July 1st. So by July 1st, you wait about 183 days. You have to close the new 1031. So if you file extension, you will know the acquiring price. So you can file the tax return for the previous year. So you know how much you sold and how much you're buying back by the July.
Right.
So in that way close. You can report. Then you can report on the 1031 form, 8824 form. So you will know how much price did you buy. So okay. The key answer is file extension to cover the period when you pass.
If they hasn't closed, but if it closed, you can still have filed it.
If they already closed before April 15, then you will know how to report, right?
Mm-hmm. Yeah.
If they are 183 days is after April 15, they need to file extension.
Got it. Yeah. Mm-hmm. Next one is, my friend hasn't received any stimulus checks. Will the first and second stimulus check amounts be based on 2018 or 2019 or 2020 tax year income? They haven't filed 2018, 19, or 20 tax return yet. Can they still claim the first and second stimulus checks? Do they need to file 2018, 19 taxes before they file the 2020 tax return?
No. Okay. If they haven't got any of them, all 3 of them, they just need to file 2020 to get the first stimulus check and the second. So they file the tax return for 2020, okay, to get the first and the second. And they need to file 2021 to get the third stimulus check. They don't have to file 18 and 19, but they do need to file 20 and 21 to get all 3 stimulus check.
Great. Okay, for any tax returns, it can be amended within 3 years. For example, this is good. This is a comment. That's wonderful. I think I caught almost all the questions. Our time is up too. Thank you so much, Bean. That was absolutely enlightening. This concludes our seminar. So we will end the recording now. You have also been unmuted to say thank you to our guest, Bean Zhai. The next T.A.N seminar will be in March, and it will feature Yan Zhao, the mayor of Saratoga. We'll be talking about real estate housing elements I will also be talking about a little bit about SB9 as well. You don't want to miss it. So look for the announcement in your email and WeChat for the exact date. I'm Coco T.A.N, your neighbor, your realtor, and I look forward to talking with you. And I want to make the miracle with you as well, like this one, $1 million over asking price. And also this one, 46 offers for one property. So I hope to make the miracle happen for you as well. Thank you so much, everyone. Have a great evening.
Thanks, Ben. Thanks, Coco.
Thank you.
Thank you, everyone. Mhm.
Thanks, Ben.
Yeah, you're welcome. Thank you. Be here.
Thank you.
Okay.
Thank you. Thank you.
Thank you.
Okay.